Today we're going to take an S corporation. I'm going to show you how you can use it to get more tax-free income in retirement, pay less in taxes, have more money in retirement, and possibly retire a little bit earlier. What's going on, guys? Welcome back to the channel, or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle, and let's go ahead and get started. So I'm going to walk you through the numbers of this S corporation, then I'm going to show you all the changes that we can make and all the math that is involved. So in this S corporation, there are two ways that we're going to have income. The first way is going to be a distribution. So we're going to have $145,000 in total distributions, and then we're going to have a W-2 paycheck of $100,000. Now, if you're not familiar with how these two numbers work, the amount of your distributions, which is income, it's basically looked at as like an investment. So it's going to avoid your FICA taxes, which are your Social Security and your Medicare taxes, both for the employer and the employee. Now, you have to pay yourself a W-2 wage if you have enough income, and that wage is going to be subject to your FICA taxes, both on the employer and the employee side. Now, as a side note, with your W-2 income, you have to pay yourself a reasonable wage, but I'm going to get a little bit more into that in just a minute. Now, on this $100,000, it is 7.65% for the employer and then 7.65% for the employee, making it a total of 15.3%. So on $100,000, we are going to have $15,300 in total FICA taxes. Now, if we add these two numbers up, our $145,000 and our $100,000, that's going to be $245,000. That total amount is subject to your federal income taxes. So we have a standard deduction here for the married filing jointly for 2023 of $27,700. So what we are left with is our taxable income of $217,300. Now, from this amount right here, we're going to pay a total federal income tax of $38,952, which puts us in that 24% tax bracket. Now, a lot of people get confused how our taxes work, so I'm going to go ahead and bring it up on the screen here really quickly just to show you how those taxes actually break down with your tax brackets. So drawing it out here might be a little bit easier to understand. So we have a gross income here of $245,000. That's standard deduction at $27,700. Bring that taxable income to $217,300. But if we go back up to the $245,000 and we just kind of illustrate it right here, this is the full $245,000. So we can see the standard deduction at $27,700. It's right here. And if we hover over this, we can see that it's at the 0% tax bracket because it's the standard deduction, so it's not taxable. So visually seeing this might help you understand how their taxes actually work. And then you can see in our next tax bracket here at the 10% tax bracket for the next $22,000. And then we have $67,450 at 12%. And then we have $101,300 at our 22%. And then finally, this $26,550 is at 24%. And you can see those tax brackets right here. So even though we're in the 24% tax bracket, you're not paying 24% on every dollar, just $26,550. So now let's go ahead and take a look at our total taxes. So what we have to add is our total federal income tax. So that's the $38,952 plus our $15,300 because we're the S corporation owners. So we're paying both the employer and the employee side, and that's the way you should be looking at it. So if we add both of these numbers together, that's going to be a total tax liability of $54,252 based on our $245,000 of income. Now, let me show you what the retirement plan contributions numbers look like before we jump into some changes that we're going to make. So if we take a look at the 2023 numbers, we can see them right here. For 2023, into our solo 401k, we can make an employee contribution of $22,500, up to a total of $66,000 of total contributions, which include both the employee and the employer side. Now, we do have the SEP IRA down here, and that's $66,000. So if you are considering the SEP, here's how that math would break down. Either the solo 401k or the SEP, it's only going to be based on your W-2 compensation. You don't include the distributions. Those are not included at all when it comes to retirement plans. So you only include the $100,000, and for an S corporation, it's up to 25% of whatever the W-2 is. So in this case, it's going to be up to $25,000. So if this was a SEP IRA, you can only do $25,000, period. But the solo 401k, we can do the $25,000 plus that $22,500 for 2023. So that total amount that we can contribute is going to be much higher with the solo 401k in almost every single instance, unless your income is way high where the profit sharing contribution would equal $66,000. So what we want to do from here is actually make some adjustments. So what we can do from there is we can actually bring down our W-2 income to $66,000. This is going to have a significant impact on your total taxes alone. Because we're reducing our total taxes to $66,000, we can still contribute the maximum amount of $66,000 to our solo 401k. But again, if you have a SEP IRA, you can only do up to 25% of this $66,000 and not a non-deductible contribution or an employee deferral on a pre-tax basis. So by reducing our total income to $66,000, two things you need to know. First, it's going to reduce our FICA taxes quite a bit. That's a bonus. Number two is this number has to be a reasonable wage. Now, I do have a video on reasonable wages and how to figure that out, but in a nutshell, it has to be in line with what your job description is and how much somebody makes in your industry. So there's no real formula or hard and fast numbers that you can go by, but you do need to justify it in the event that you get audited and you're paying yourself too little. Why would somebody do that? Obviously, to avoid the FICA taxes and have it all come out as a distribution. But unfortunately, you can't do that, nor do you want to if you want to put those dollars into a retirement plan. So by doing that, we're actually going to reduce our taxes from $15,300 down to $10,098. This means that this isn't going to increase just by $34,000. It's going to be $34,000 plus the difference in our FICA taxes because we're going to retain those dollars. So that means our total distributions will increase to $184,202, bringing our total compensation to $250,202. And then we subtract our standard deduction, bringing it down to $222,502. And our federal taxes are actually increasing here to $40,208 because of those additional FICA taxes that we're now keeping. And that's going to keep us in the 24% tax bracket. If we add all this up, though, it's still lower at $50,306 versus our $54,252. But that's not the only thing that you need to be aware of. So let's go ahead and show a side-by-side comparison of these contributions. So let me go ahead and bring these up for you. So here's how it's going to look. Side-by-side with $100,000 of W-2 income versus $66,000. So the employee contribution to that solo 401k is going to be the same at $22,500, but our profit sharing will decrease because you can only do a maximum of 25%. So it's going to drop from $25,000 to $16,500. Bringing that total pre-tax contribution from $47,500 down to $39,000. So there's something I want to point out before we continue here. So the FICA taxes are not affected by your retirement plan contributions. So whether or not you put it into the pre-tax or the after-tax side, the traditional versus the Roth side, it doesn't matter. What is being affected here is the federal income taxes. So if we're putting into the pre-tax side, your federal income taxes go down. But again, it doesn't affect those FICA taxes. So here's what we need to take a look at now. So we have $100,000 income and $66,000 income. Well, guess what? Our FICA taxes are lower now because we're at $66,000, and FICA is our Social Security and our Medicare taxes. So if our Social Security is less that we're paying into, that means we're going to get less out of it. So let's go ahead and compare what the difference in these two numbers would be with Social Security. And I've already run those numbers. So for somebody that's earning $100,000 from age 40 till age 70 and then has a 30-year retirement, this is the estimated amount of total Social Security if you're married filing jointly with these estimates. So it's going to be up to $5,653,176 if you're earning $100,000 per year. Now let's go ahead and make some changes here, and we're going to drop this income down to just $66,000, and we're going to see what that effect looks like. So $66,000, we're going to drop that down, I'll click save, go back to our retirement, and we're going to take a look at our Social Security, and that is going to drop quite a bit down to $4,628,053. So now we're left with figuring out how to make up that difference, and it's a big one. It's over $1 million, but here's how we're going to do it. So to be exact, that amount is a difference of $1,025,123 in total Social Security over the course of our retirement. So what we're going to do is figure out how to take the difference in our FICA taxes from our $100,000 and our $66,000, which is a difference of $5,202. This is the amount that we should be saving by dropping our W-2 income. Now, if we divide that by 12, we get $433 per month. So if we take that amount and reinvest it into the stock market, let's see how that math works. So if we take $433 per month, reinvest it for 30 years at an 8% rate of return, we're going to end up with $650,378. Now, this is the amount that you would have or estimated to have day one of retirement. But again, we have another 30 years, so we're not just going to put it in a bank at 0%. We're going to still reinvest it. But let's say that we dropped it down to 5%. The maximum amount of income that we can have on 5% is $3,477. So if we multiplied this amount that we're now generating off of this for 12 months of the year for 30 years, that is going to equal $1,251,677 or $226,554 more in this scenario than if we just paid into Social Security. So, of course, there's a lot of assumptions that we're making here. We're assuming that we can get an 8% rate of return. We're assuming that we can get a 5% rate of return. But on the other side, we're also assuming that Social Security will be here. So a lot of people think that it will be reduced or it won't be here. In any case, you can see by making these changes that you're going to be better off given what we know right now. So in this example, even though we've reduced the amount that's going into our Social Security, we've increased the amount that's in our Roth, we've still saved up to the maximum of $66,000. We're going to have more total throughout the course of retirement. And as you can see, the more you have, the more opportunities you have, and possibly being able to retire earlier. So a lot of little tweaks that we've made to two different scenarios to make it a better scenario given what you're currently working with an S corporation. So if you have any questions on this stuff, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.